Hi everybody, this is Thomas from Wynn Capital with the first quarter market summary. Before we get into it, let's take a look at the market in general and take a look at the S&P 500 graph. This is the dividing line between 2021 and 2022 over here. The market made all-time highs right at the end of 2021. Fell about 27% to make the lows on October 13th. Rallied 19% from the lows, and are currently year to date from the 1st to the 31st of March are up about 8.4%. I've called out this date, the 13th of March was the date that the announcement for Silicon Valley Bank failure happened, and counterintuitively the market's gone up ever since. So that's all I'm going to spend time on that. Let's take a quick look at our model portfolios for Wynn Capital Management. On the screen now is our performance, and you can take a look at this in detail, but I'm just going to call out the two top lines where our clients were down about 11.9% after all fees. The benchmark was down 15.9. We outperformed by 4 percentage points, which is 25% better, basically saving about a little over $2 million. Our REITs, which are companies that I've vetted personally, did much better than normal. They're meant to be very, very conservative and income producing and capital preserving, and they did what they did. Pretty dramatic. Ours made, as they almost always do, around 6% or so, and the general benchmark for REITs was down a lot. I'm going to produce a more robust review of our performance from the near term to back in time in another video. So let's get into it. This is the first, looking at the quarter. Every arrow is up, so every type of asset from stocks across international and emerging market and real estate was up. Bond market now is starting to rally, even though the Fed continues to raise rates. Those are Fed rates that affect money market, CDs, and other things. But most of the rest of the market is influenced by the Fed, but can often go in the other direction. So out in the government bond market, rates are declining and the price of bonds are going up. And again, this part down here is always very helpful to see what the average for these asset types in the best and the worst quarter is also very helpful. This looks at all the same thing for the year, and this gives us context that everything's down for the 12-month period. But in the 5-year period, almost everything's up except for emerging markets. And then when you look in longer terms, this is why people invest. If you stay invested for the long term, you usually can capture the returns of the market. Now, these 10-year returns do fluctuate. There's some 10-year periods better than others, but this is the reason people invest. The news that was happening during the quarter, along with the price fluctuations and all the things that you remember seeing on TV or on your internet feed. Those are the news items for that period. This is the news items for the 1-year period, for the 12-month period. A little bit of a longer view. The news has been bad in general, but as I said, the market has been rallying about 19% from the lows. We're going to take a look at stocks of all types, U.S. first. I always like to point out that the U.S., its single country, has 60% basically of the value of all global stocks. We dwarf pretty much everybody else. Everybody else is only about 40%. Tech and large growth made a big rebound from the very steep declines that they had previously. And small cap value, which is what we overweight, did not as good, obviously. And the longer term returns are listed down below here. If we look at the developed other countries, 30% are in the big developed countries that have big stock exchanges and stock markets. And same thing, growth was the leader, and small and value stocks were trailed in that period. Emerging markets have had a really rough time. The 1-year returns and even some of the 5-year returns very, very low or negative. And No one knows when that'll return. The emerging markets do tend to outperform the U.S. market over time. They're very volatile and they're very risky, but over time they tend to outperform. These are country returns, and I've highlighted the U.S., which is towards one of the better performing countries, but it was a mix of some countries down and some countries up. Real estate that I called out earlier, REITs are rallying. Global REITs were still down, and I've entered, these are the U.S. REITs and global REITs over the quarter all the way out to 10-year annualized returns, and I've put the two REITs that we have. They're unusual REITs, obviously, because they're doing the opposite of what, in this particular year, of what most REITs are doing. And I'll explain in greater detail why our REITs do better. But in general, it's just that I've been able to vet things that have lower volatility, less risk, and have really stable income. Commodities are always interesting because they go back and forth so fast. Natural gas is probably maybe the most volatile asset on here. If we look back at the last quarter, it might have been up 60% in the period. Now it's down 60%. But all of this, with the fossil fuel composite, all of these fuel types are down, and that's leading to the slight decline in inflation, which is eventually lowering interest rates on non-Fed influence bonds. And if that keeps up, which I guess we all hope it does, we'll start to have lower inflation, and the stock market will like that better than high inflation. Bonds, this chart, you probably heard the yield curve, the inverted yield curve. Normally short-term rates are lower than long-term rates, the 30-year versus the 3-month. But right now, a one-day money market fund and 1-month CD are almost 5%, and way out on the 30-year bonds, 4% or lower. So that is something that happens when people are afraid of the near term, that rates will be high, but they're anticipating lower rates going forward. This is the editorial comment by Dimensional Fund Advisors, one of the partners that we work with, and I've highlighted the headings of these, and it's basically our philosophy and our investment principles. I shared the investment principles long before I came to use Dimensional Fund Advisors. I just found them as a mutual fund company and other companies like them that had the same philosophy, and it's basically trying to diversify, not spending our time market timing, and just trying to capture the returns of the market with the lowest cost, lowest taxes, and the least volatility. So that is it for now. All my contact info is here, and if you have any questions or comments, you're welcome to get in touch with me anytime. I hope everybody's well, and I'll see you all soon. Bye-bye.